Okay, let's continue the discussion for the available for sale security. So the difference between the comprehensive income and the late income is the comprehensive income is directly going to balance sheet to increase or decrease the retained earnings in the owner's equity. So the SEC and first of all want investors differentiate the comprehensive income from the late income in the income statement, because the price change of the fair value have this gains or losses, which is very different from the normal regular operating profits. So so because of this kind of motivation, the unrealized holding gains and losses result from the price change for the available for sale security will avoid going to income statement and directly going to balance sheet as a comprehensive income. Okay, and then other things are the same as the trading security. So I mean, here you will see the third stage is when a security is sold, the realized gains and losses will include in the late income. And so, and any unrealized holding gains and losses must be reclassified as accumulated other comprehensive income into late income. So because at this time, the profit is already, or loss is already realized. So we need to recognize in the late income. Okay, see the example. In this example, the investment is on January 1st, 2019, Morgan Company purchased a bond for $195,000. And then the face value is $200,000. So there is a discount of $5,000. We need to amortize this discount in the following holding years. And then the stated interest is 10%. And the maturity date is December 31st, 2028. And Morgan doesn't want to hold it to maturity, just the one say, if the price is good, they will sell. And so the discount will use a straight line method for amortization. So on the purchasing day, debit investment in available for sale security, credit cash. That's easy, right? And then on the June 30, 2019, we need to do two things. One is amortize discount, because we have $5,000 discount. And another thing is measure interest income. Because the stated interest rate is 10%, so we receive cash $10,000 and amortize discount $250, because it's a straight line method amortization. So it's $250 in this half year. And in interest income is $10,250. And also we need to recognize the fair value change for the unrealized holding gains and losses. And this gains and losses, so it's other things are similar to the trading security. The only difference is a created balance in the unrealized holding gains represent the cumulative late unrealized holding gains, and is reported as a positive element in the accumulated other comprehensive income of the shareholders' equity. It's not going to the income statement, which is to differentiate the change of the fair value from the regular operating profit. Okay, so same time, the debit balance of the account realized represents cumulative late unrealized holding losses, and it's a negative element to decrease shareholder equity as a comprehensive income. Okay, see the example? On December 31st, 2019, the amortized cost of mortgage investment in available for sale security was $195,500. So that's the book value, and the fair value is a line $199,000. So we have a allowance for change in fair value investment. So it's, I mean, the fair value is 3,500 higher than the book value. So it's unrealized gain, debit, allowance for change in fair value of investment, creditor, unrealized holding gains. That's so on the balance sheet, the value is 199,000 fair value of the security. So we use an allowance account to record the changes in the fair value of the security, and which allow a company to retain information about the amortized cost of each security that will be used to compute the realized gain or loss on the sale of the security. Okay, see the example on the sales day. So Morgan reports 3,500 increase in the fair value as an unrealized holding gains in other comprehensive income for 2019. So, and then in the sales day, on December 31st, 2020, the required amount of mortgage allowance account is 2,000 debit balance. That means the value is a decreased sum, and so the fair value is $198,000, but the balance sheet, the book value, the amortized cost is $196,000. So same reason, same generalization, we recognize the 2,000 debit balance in the allowance account. And then Morgan's previous balance on December 31st, 2019 was 3,500 debit balance. So at this time, we need to recognize the difference, $3,500 and $2,000. So Morgan credits the allowance counted for 1,500 at the end of 2020 to record the decline in fair value. So the unrealized holding losses, debit unrealized holding loss, credit allowance, for change in fair value investment. So on each reporting date, if the fair value is higher than the amortized cost, the book value, then we recognize this price increase. Otherwise, we need to recognize any fair value change on each financial reporting date. And the generalization it's easy. It's just if it's gain, debit allowance for change in fair value loss of investment. If it's loss, then credit. Okay, and then realize the gains and losses. That means is the procedure 3. After you sold the security, how much money you made and or loss. So recognize the profit. And this recognition need to compare the sales price and the amortized cost, the balance of the security in the balance sheet. Say, for example, on March 31st, 2021, Morgan sold its investment in available for sale security for $197,000. And the amortized cost on this day was $196,125. And so there is a difference. The difference is the realized gains. So we receive cash $197,000, debit cash, credit investment in available for sale security. That's the amortized value, book value, and credit gain on sale of available for sale security. That's the realized gains. And also make it because we have $2,000 price change in the previous date. And it's over here. We need to treat this $2,000 after we sold the assets. Okay, sorry. Sorry, what the matter? Okay, so debit unrealized holding gain and credit allowance for change in fair value investment. Okay, I think that's for available for sale security. And here is the explanation about this journalization. The first journal entry recorded the sale and realized the gain 875. The second journal eliminated the unrealized gain accumulated from January 1st, 2019. And then the unrealized gain had previously been reported in other comprehensive income. That's the reclassification adjustment because it's sold. So it's leads to a reclassification. And we deal with this this price change, use this journalization. Okay, and the next video will be accounted for transfers and impairment. I will speed up a little bit in the next slide. See you again.